Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 170. On today's episode, we are going to talk about the One Big Beautiful Bill. This would be the episode equivalent of eating your vegetables, because it's not like people really enjoy discussing taxes. But I do want to break down some of the highlights of that bill, the financial piece of that bill, and how it could impact you. We'll also talk about some of company earnings that came out this past week. So we had bank earnings, Netflix reported earnings. And so we'll try to sum all that up, let you know how the One Big Beautiful Bill is going to impact you and your taxes going forward. So as always, get your mind right and let's get to work. Well, welcome back to the show, everybody. Thanks again for joining me. If you're watching this, it's going to be one of the last ones filmed in my home studio. So that's what they call a teaser in the business. So we got some stuff working on a podcast studio and all that kind of good stuff. So we look at the markets. Man, you look and what a difference a couple months make. I mean, all the indexes are positive for the year. And so we're looking pretty good. So we're coming up on earnings season, and this is going to be second quarter earnings for a lot of different companies, or all companies. And it's going to be an interesting earnings season because so many companies, when they did their first quarter earnings guidance, they really didn't give guidance. There was a lot of companies that actually did not give guidance. So guidance is them telling Wall Street how they think they're going to do over the next couple months. You know, what do they think their sales are going to be? And a lot of them didn't give guidance because they didn't know what was going to happen with tariffs, and they didn't know how it was going to impact their companies and how consumers were going to spend and all of that. So there's a lot of companies that actually didn't give guidance. So we'll see. This previous week, we had the banks report earnings. Pretty good. Goldman Sachs, Morgan Stanley had good earnings. There's been a lot more of M&A activity, so that's mergers and acquisitions. There's been companies that have been coming public, so that's the IPO market, initial public offerings. So there has been more activity in the financial sector. There's also been, those companies make money when you trade. So the JP Morgans, Wells Fargo, those banks, when investors are moving a lot of money in and out of the market, so think trading activity. Morgan Stanley owns E-Trade. That generates money for those companies. So, that activity ends up helping them out. So, we'll see. One of the tech companies that reported earnings this past week was Netflix, and Netflix, strong earnings. The stock has moved down a little bit, even though they had good earnings. The stock dropped a little bit, but I would not be worried about them at all. I actually hope if they drop a little bit more, I'd be interested in purchasing shares. And so that could be one of the themes of this earnings season, is that we have had a nice resurgence in the market over the past 8 weeks. And so if company earnings aren't perfect, they could get knocked down a little bit. The stock could drop a little bit because of that. Seasonality is also important to remember. So August, September are seasonably not very good months for the market. So this is for you if you're an investor who feels like they missed some of this upside that we've had over the past couple months from that, the tariff uncertainty and then the market resurgence from then. You might get the opportunity to purchase some of the stocks you've been wanting to over the next couple months after earnings. So this is why it's important to have that list of companies that you're thinking about investing in, paying attention to those companies, tracking those companies, following those companies, so that if there is an opportunity for you to be able to invest, you're going to be able to take advantage of that. So you'll see that over the next couple of weeks. We have a Fed meeting coming up as well at the end of the month. So I'm sure we'll talk to you before then, but we have a Fed meeting at the end of the month. Obviously, there is a lot of pressure from Donald Trump onto Jerome Powell to lower interest rates. And so he's talked about firing him, which there is a lot of steps that have to occur before he could actually fire the Fed chair. He is a Donald Trump appointee. And this weekend, Donald Trump called him one of the worst appointments that he's made as president, even though it was during his first term. And so the expectation is that Jerome Powell will his term ends next year. And so it's, Trump trying to put pressure on him to lower rates, all of those things. So we'll see how that impacts the market. That definitely creates a little bit of, instability. But so far, the market has been able to kind of shrug that off a little bit. And so we'll see. But going back to Netflix actually announced, and I'm bringing this up because we have so many Dallas listeners. But Netflix actually announced that they're going to do this thing called Netflix House. And they're going to open 2 of these, one in Philadelphia and one in Dallas. So Netflix House is going to be basically kind of a immersion type deal where you would actually get to be what they call the main character in a lot of their shows. So the Dallas Netflix House is going to have, Stranger Things, Squid Games, and then this thing called Netflix Replay, where basically, if you watch Squid Games, you actually get to go in and participate in some of those events. Kind of like I don't want to call it Disneyland, but basically like they're going to have just things where you can actually participate inside some of their shows where they basically have built the sets and done all the things where you can do that. You can eat, basically hang out with your friends. And the one in Dallas is going to be located at the Dallas Galleria. And it says it's going to open by the end of the year. So you can actually go to the site, you can sign up, you can get on the wait list. And, if that's something you're interested in, but it'll be very interesting to see how these perform for Netflix, because Netflix has done so well, but for them to actually do a location that you can go to versus them just being in your home is going to be a big deal. I'm sure the malls that they picked for this are very excited because malls definitely need some kind of resurgence for people to actually show up there. So we'll see how that impacts, and definitely investors will be wondering, man, is this like another next level for Netflix? If these do well, think about all the different places that they can put these. I know they're also looking at doing one in Vegas. So we'll see how they perform for them. One of the main things I wanted to talk about today, and I said it in the opening, was that this is the equivalent of like eating your vegetables. But the one big beautiful bill passed on July 4th. And I didn't talk about it for a while or actually I haven't really talked about it at all. And the reason for that is that I don't like to talk about political things or different tax bills or things of that nature until they actually pass. Because normally there's so much back and forth that happens between the House and the Senate, and the way that you think a bill is going to pass gets changed. And so really I don't talk about them until they actually pass, because over time and over the years, I've seen so many investors make the mistake of investing in something because they believe something's going to pass or that something's going to end up one way or the other, and then it doesn't, and that it changes the investment on them. And then all of a sudden, something they thought was going to be a good investment isn't a good investment. And so this does remove a big overhang that was going to kind of hit later in the year. But the one thing I wanted to focus on were the financial highlights of the one big beautiful bill, so that you can kind of figure out how it's going to impact you and your personal taxes and all those things. So a couple of the big highlights of this is that the permanent tax cuts from 2017 are going to remain in effect permanently. So that's going to be big key, that the tax rates aren't going to change. So the highest tax bracket's still going to be 37%. That was supposed to basically go away and kind of go back to what it was. The standard deduction is going to increase. So for 2025, the standard deduction is $15,750 for singles, and $31,500 for married filing jointly. And then additionally, if you're 65 and over, then there is going to be another $6,000 senior bonus deduction. $6,000 if you're a single filer, and $12,000 if you are a married filer. And so that adds on top of that deduction. And that's where they're trying to get. So you remember when Donald Trump campaigned, he talked about making Social Security tax free. And so this senior bonus deduction on top of that is to where it's going to basically allow seniors to have a little bit higher deduction, which will offset some of the taxes on that Social Security. And that it's not going to be completely tax free, but it does include a little bit of that. I will say that for a lot of this, like the senior bonus deduction, it's all subject to income phase outs. So what that means is the more money you make, they start to phase this out. And, sorry, but if you make a lot of money, like this isn't going to apply to you. So you're going to have to look at, obviously, there'll be a big disclaimer at the end of this one, but your individual situation, talking with your accountant, seeing what impacts you, that kind of thing. One of the other big highlights was the what they call you might have heard it on the news, called the SALT deduction. Well, that SALT deduction stands for state and local taxes. And this is definitely important to those individuals that live in a state that has a state income tax. So for listeners in Texas, it isn't that big of a deal on the state tax, because Texas doesn't have a state tax, but it is on local taxes. So think about like local property taxes and those things. And so before this bill, it was capped at $10,000. So that was what you were able to write off. It is going to rise to $40,000, and they're going to add 1% to that annually for inflation through 2029. But again, it will start to phase out if you are a high income earner. So as your income goes up, a lot of things that the government does for, these deductions and whatnot start to phase out. So you have to pay particular attention to this if you are a high income earner, or especially those of you who have gotten, maybe a big bonus, or the company sold and you got a big payout that year, those kind of things. They're doing above the line deductions for charitable donations. So $1,000 for single, $2,000 for joint. That starts in 2026. So there'll be more, information that comes out about that, but that's not going to be something that has you impacted this year. And then, of course, the tip and overtime deduction is also going to be was one of the big parts of this bill. So temporary deduction for tip income up to $25,000 in overtime pay through 2028. Now, the one thing I want to discuss on this, let me find it. I had it up and now I got to find it. So, workers in tip-heavy jobs, like it says restaurant servers, salon staff, can deduct up to $25,000 in qualified tips from their income. And, the tax deduction would decrease once a worker's income hits $150,000 for single, $300,000 for joint. So you're hearing me say that for single, for joint, those kind of things, depending on how you file your taxes. So there's single, there's head of household, there's joint, married filing jointly, there's married filing single, like, depending on how you file your taxes, you have to look at that specifically to make sure you're kind of staying on the right track. So they're basically reporting there's about 4 million U.S. workers that are in tipped occupations in 2023, or about 2.5% of all those employed. And so looking at that, now here's the thing. So, something to keep in mind is everybody's like, well, man, maybe I should start taking part of my salary as tips or whatever, right? So the IRS is going to release a list early October they say October 2nd of this year, that they're going to release a list of eligible tip earning jobs. So this is to try to prevent people from what we call gaming the system. So no matter what happens, there's always going to be this, individuals who try to game the system, especially the tax system. So those of you who are like, man, I'm going to change my job to where I get tip instead of income, to try to maybe tilt the balance balance into your favor. You're going to have to make sure that you're on that list. So the IRS is going to release that list, and that'll try to prevent people from gaming the system. So we'll see. So, and then you have no tax on overtime. And so that'll be the half portion, time and a half. And that's going to be an annual deduction of $12,500 if you're single, or $25,000 if you're joint. But again, if you make over $150,000 as a single filer, $300,000 as a joint filer, you're going to phase out of that. So a lot of these are going to have phase out provisions. Another one that's pretty big here is the auto loan deduction. So you'll be able to start deducting the interest you pay on a new vehicle as long as they are assembled in the U.S. So we will. This is again the Trump administration trying to get more manufacturing back in the United States, and so this is a way of kind of basically using consumers to request vehicles that have been assembled in the U.S., incentivizing automakers to do this to drive that consumer demand. So interest on loans on new vehicles, as long as they're assembled in the U.S., would be able to deduct the interest. That's deductible through 2028. So, you have to think about it. You'd have to put your car on a 3-year plan here to if you were buying, and you can deduct up to $10,000 of interest a year if you do that. And again, if it's U.S. assembled, all of those things. So you'll have to check on that if you're looking to buy a vehicle. It does not include used cars, and it does not include leases. So it would be something that you would have to buy new, assembled in the U.S., that kind of thing, and you can deduct it through 2028. The child tax credit permanently increased to $2,200 per child, so that you can write expenses of children off. And by the way, man, if you have kids, man, the $2,200 does not go very far. I'll tell you, it's helpful, but it's not that helpful. But it's something. Okay, so the other one, business and employers. So 20% of qualified business income is going to permanently stay in place as a deduction. The big key for businesses, though, is that they changed it to where you get 100% bonus depreciation. So immediate expensing is reinstated from January 19th, 2025 through at least 2029, 2030. So this means as a business, if you buy something for the business, buy equipment, all things like that, you're going to be able to deduct 100% of that in the first year. So this is a big key for businesses, people who are doing those things, buying equipment, maybe building a new location, somebody who, I don't know, might be putting a podcast studio in their new building. You can write off all 100% of those deductions. So things that you thought maybe, it's going to take me, I'm going to be able to write that off over 7 years. No, you can write that off all at once. And this is, again, I know many of you that are listening to this are, you work for somebody, whatever, but this is one of those reasons why being a business owner, having your own thing, trying to have your own thing is so key, because there's just so many tax advantages of being a business owner. So that's definitely going to impact research and development cost for companies. Expensing research and development costs, that's going to be able to be deducted immediately. So by doing this, they're trying to generate activity, right? They're trying to encourage businesses to research and develop. They're trying to encourage businesses to, if you want to build a factory, if you want to build a data center, if you want to build something in this country, we'll let you deduct 100% of that, because it generates, obviously, the places that you're buying your equipment from, doing all that, right? That's going to be income for them. They're going to pay taxes on that. So even though, there's some give and take there. So that's the thought process behind that. For estates, the estate and gift tax exemption is now $15 million for individuals. So that's going to be key. One of the negatives is that clean energy credits are expiring. So they're going to expire at the end of this year. So that's December 31st. So that's EV credits, home energy efficiency, that kind of thing. So that's going to be a big one. And then, they're expecting this to boost GDP, but it's also going to increase the federal debt. The big, beautiful bill is going to increase the debt, which is why, again, comes back to Elon Musk, Donald Trump fighting. Musk is mad that about how much is going to be added to the U.S. deficit. So we will see what ends up happening with that. And then the other one is the Trump accounts. So this is another one that we've been wanting to talk about, where for every child born in the U.S., it's going to be called the Trump account, where they're going to put $1,000 into that newborn's name. And you will basically be able to add to that if you want. And then later on, the child will be able to use it for education expenses, things like that. So the Trump accounts are going to put $1,000 into your child's name, and this is going to be retroactive. So if you had a baby on January 1st of 2025, they would be eligible. And then parents, relatives, other people will be able to contribute up to $5,000 a year into these accounts. And so, they're basically going to grow exempt from taxes until the child is 18, and then they can use the money for certain things. So this is where, how they can use the money is definitely going to be a big deal. They've also said that companies can contribute to these accounts. So companies like Dell, for instance, Dell said that they would match for all of their employees. They would match the $1,000 that the government's putting into those accounts. The employer contribution is going to be capped at $2,500, but parents can contribute up to $5,000, like I just said. So there's going to be certain rules. No distributions are going to be allowed until the child reaches 18, and also contributions can only be made until they're 18 years old. You cannot put any more money in after they turn 18. And so no distributions allowed till 18. After that, they could access 50% of the money for higher education, training programs. They could even do small business loans or first-time home purchases. So that's at 18. They can have up to 50% of the money for those. At 25, they can withdraw the full balance of the account, but only for the things we just mentioned. So at age 25, they could deduct it. They could take out all the money for education, training programs, small business loans, first-time home purchases. And then at age 30, they could actually withdraw all the money for whatever they want. So 18, they have access to 50%. 25, they could have access to the full amount for those four things. And then at 30, they can have access to the money for whatever they want to do. So that'll be key. They at first wanted these to be tax-free when you pull out the money, but they've actually said that is not going to be true, that these are going to be taxed at long-term capital gains. We're talking about something, if they set this up today, we're talking about taxes that are going to be paid 18 years from now. So I'm not really going to go into that much because, that could change over the years, because you're talking, we're 17 years away if a child was born now from them being able to have access to that money. So there's a lot of things that can change, a lot of moving parts that can happen between now and then. And so for right now, they're going to do a pilot program. And so this is going to be, applicable for any citizen born between January 1st, 2025 through December 31st, 2028. And so we'll see. And so there's going to be, apparently they're working on the rollout now on how you're going to be able to open these accounts. A lot of parents are going to be able to set them up for themselves, but they're also talking about the Treasury Department being able to open accounts for kids whose parents don't open it for them. And so obviously there's going to be a lot of management that goes into this, because there's about 3 million babies born every single year in this country. So you're talking about 3 million accounts from the get-go. So, the management of this is going to be key. The different funds that you can put these accounts into, which are going to be things like the S&P 500, those kind of things. So we could talk about the base of, when you start getting these over the years, like what kind of floor that's going to put on the S&P 500. I'm sure there's a lot of financial companies that are fighting for some of these accounts. So we'll see how this is actually going to be. It's one thing to pass this. It's the implementation is a completely different thing. So we will we will definitely need to have some further conversations about how that's going to work. I've been trying to find information for my clients. I got some clients that just had babies, some clients who have babies on the way. So this is going to impact them for sure, and see how the management of this goes. Are you going to be able to do this in conjunction with a 529 plan? I mean, there's all those kinds of questions that are going to occur. So it's one of the things that as this kind of gets going with that, we definitely need to pay attention to and see how the implementation of this is really going to work in real time. So, not the funnest episode, but it's an episode that's needed, right? We got to make sure that we take care of our taxes, that we do the right kind of tax planning. You got to have this right, because if you do well on your investments, but you don't have this part right, you definitely need to make sure that you're working with somebody that can help you take advantage of kind of how this goes and how your individual circumstances are going to be impacted by this. So I thought that would be a good episode to just kind of discuss this, see how things are going, do a check, give you some questions for your tax preparer so that you can, have the at least a base of knowledge and actually know what to ask for. So I think that's pretty good. As always, don't mistake activity for achievement, and we'll see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be construed as a consideration or solicitation to buy or sell any security. Right Our Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstance. Past performance is no guarantee of future results.